Return on invested capital, ROC, is a crucial financial metric used to evaluate the efficiency and profitability of a company's investments. It measures how well a company generates profit from its invested capital, which includes both equity and debt. ROIC is particularly valuable because it provides insight into how effectively a company is using its capital to generate returns, compared to other profitability ratios that might only consider equity or focus on net income alone. This ratio helps investors and managers assess the effectiveness of business investments and operational efficiency. Return on invested capital, ROC. ROC gauges how much profit a company earns on every dollar of invested capital. To calculate ROC, you start by determining the net operating profit after taxes, NOPAT, which is the profit a company makes from its core operations, adjusted for taxes. Then, you divide this amount by the total invested capital, which includes both debt and equity used to fund the company's operations. Example: consider a company that has a NOPAT of $2 million and invested capital of $10 million. To find the ROC, you would divide the NOPAT by the invested capital. In this case, the ROIC would be 20%, meaning that for every dollar of invested capital, the company generates 20 cents in profit. If a company has a higher ROIC compared to its competitors or its own historical performance, it indicates that it is efficiently utilizing its capital to generate profits. Low return on invested capital. A low ROC suggests that the company is not generating sufficient returns from its capital investments. This might indicate poor management decisions, inefficient use of resources, or that the company is investing in projects with lower than expected returns. A consistently low ROC could be a red flag for investors, as it implies that the company might struggle to deliver value to shareholders and could face difficulties sustaining growth or profitability in the long run. High return on invested capital. A high ROC, on the other hand, signals that the company is effectively using its capital to generate substantial profits. This generally reflects strong management performance, efficient operations, and effective investment strategies. A high ROC can also indicate that the company has a competitive advantage and is able to generate higher returns compared to its peers. Investors typically view a high ROIC as a positive sign of financial health and operational efficiency. How can companies optimize return on invested capital? Improve operational efficiency. Companies can increase ROC by streamlining operations and reducing costs. Enhancing productivity and efficiency in the use of resources can lead to higher profits without necessarily increasing invested capital. Focus on high-return investments. Prioritizing investments in projects or ventures that offer higher returns can improve ROC. Companies should assess potential investments carefully to ensure they align with strategic goals and provide attractive returns. Optimize capital structure. Adjusting the mix of debt and equity to minimize the cost of capital can boost ROC. Efficient capital management involves balancing debt and equity to ensure the cost of capital is low while maintaining financial flexibility. Key takeaways. Return on invested capital is a critical measure of how effectively a company generates profits from its capital investments. By evaluating ROC, stakeholders can gauge the efficiency and profitability of a company's use of capital. ROC is a useful metric for assessing how well a company is using its capital to generate returns, providing insights beyond basic profitability ratios. A high ROC indicates efficient use of capital and strong financial health, while a low ROC suggests potential issues with investment efficiency or management. Companies can optimize ROC by enhancing operational efficiency, focusing on high-return investments, and managing their capital structure effectively.